Well, hello there, we are the Taupo-nui-a-Tia Monetary Policy team. So we recommended that the official cash rate was held at 3.5%. We reached our decision by looking at the key factors, potential output and all the components of aggregate demand. We created an OCR scale to demonstrate the effect of each factor on inflation. When the scales tipped too heavily to one side, we could see that we would need to change the OCR in order to maintain price stability. Potential output can be tricky to calculate, but by looking at certain indicators, we established that the output gap is getting closer to zero, which means we are getting closer to producing at our potential output. This will cause natural inflation as resources become more scarce. For example, as employment begins to rise, then labour is becoming scarcer and thus wages will need to increase and prices will follow suit. This natural inflation from a closing output gap will tip the OCR scale slightly towards increasing the OCR. I'd now like to pass you over to Sydney.
With the 75% increase in migrants in the past year, migration has been a major contributing factor in our OCR decision. Migration levels have reached record highs in the past year through to April. We predict these net gains will continue throughout the year, boosting economic activity and inflation rates both in the short and the long run. High migrant levels should keep wage inflation low, meeting demand for labour, particularly in Christchurch, and boosting the labour force, increasing potential output. Migrant levels are also positive for firms due to higher demand for goods and services. Economic growth will result from an increase in consumer and government spending due to more tax revenue, consequently increasing aggregate demand. We feel that inflation will naturally occur in this scenario. In the long run, aggregate supply could potentially increase due to higher productivity and investments, therefore resulting in disinflation. As you can see on this graph, arrivals to New Zealand have increased by a large amount in the past year and have peaked in the beginning of 2015. Overall, we feel that migrant levels will push inflation rates towards the 2% target. Although record high house prices in Auckland have resulted in high house price expectations, consumer confidence remains healthy, and yet 7% of consumers feel they are financially better off in contrast to last year. This could be mainly due to the wealth effect as well as the strengthening New Zealand economy and average disposable income levels increasing. As shown by this graph, overall regional confidence has increased, consequently increasing consumer spending and decreasing saving levels as consumers feel optimistic for the future. As consumer spending increases, firms will receive higher revenue and therefore potentially higher profits. This could lead to higher investments and wages or employment. This is reinforced by the current conditions index, which remains elevated. As shown by this graph, inflationary expectations have hit a recent spike, subsequently increasing spending in the short term. We feel this may not have as big of an influence on overall inflation levels as other factors. Aggregate demand will increase, consequently result in inflation rates slightly increasing in the short run. In the long run, consumer confidence may not have a major influence in the OCR decision, as confidence is relatively volatile. These reasonings will cause slight inflationary pressures, so in the short run the OCR scale will drop slightly. However, consumer confidence does not have a major impact on our scale as a whole. Consumer spending remains at high levels due to high confidence levels, high inflationary expectations, a major increase in the labour force and the wealth effect. This results in higher economic activity and an increase in aggregate demand, and therefore inflation rates will tend towards 1 to 3%. The overall increase in spending may also be a result of the OCR's previous rates. This graph shows a slight increase in spending, however we feel that is not by a large enough amount to dramatically increase inflation rates in the short run. This slight increase in spending levels will further drop our OCR scale to the right. I will now hand you over to Daniel.
Thanks, Sydney. We're currently at a positive rate of 2.1% of disposable income being saved. The government has also increased its savings by almost $4 billion over the past year in the hope of reaching a budget surplus in the near future. Seeing as savings are a withdrawal from the economy, this has caused the money supply to shrink, resulting in deflation. The government has removed the KiwiSaver startup boost of $1,000, effectively making it unattractive to save. This has caused the scales to tip slightly towards a decrease in the OCR. Business confidence has fallen, down 14.5 points from April through to May nationally. Although it fell from 30.2%, which is quite a high level, this could still contribute to deflation even if it is just a small amount. Firms' activity expectations also fell over this last month, with inflationary expectations falling to a historic low point. All of these will combine and cause deflation because firms have become less likely to invest. This has led the scales to tip away from increasing the OCR. The government has increased the level of transfer payments that are handed out to low-income working families with children. The new $790 million child hardship package, which was set out in the 2015 budget, is going to cause a lot of longer-term effects, which has contributed to inflationary pressures from increased government spending, therefore increased consumption. This has caused the scales to tip in favour of increasing the OCR, as it creates inflationary pressure. Investment on the whole is on the rise, through gross fixed capital formation of residential buildings and other fixed assets. Residential buildings as a form of gross fixed capital formation is up $500 million over the past year, and other fixed assets as a second form of gross fixed capital formation has increased similarly. There is going to be a decrease in investment from firms due to business confidence falling, and overall the current state of investments is going to cause inflation, which is why we have tipped the scales towards an increase in the OCR. Auckland and Christchurch are currently dominating the housing market due to the Canterbury rebuild and the Auckland housing crisis. Nationally, house prices have risen compared to this time last year, and there's been a trend showing an increase in the number of new dwellings being consented. In Auckland currently, the average house sales price and the median price have reached $775,000 and $711,000 respectively, and will have spillover effects onto other regions as investors look to purchase elsewhere. This will cause a lot of inflation, which is why the scales have moved further to an increase in the OCR. Government spending will increase $1.8 billion over the next year to $74.9 billion in 2015-2016. The government is aiming to produce a budget surplus, which means we may see an increase in taxation levels. The increase in government spending is likely to cause inflation, which is why we have shown the scales to tip slightly more in favour of increasing the OCR. I'm going to hand you back to Scott for our final points.
Trading partners such as the United States and European Union have been bouncing back from an economic slump. However, one of our main trading partners, China, is headed towards the slowest growth since 1990. The New Zealand dollar has been high compared to most currencies for some time now and is finally starting to fall against floating currencies such as the US and Australian dollar. The effect of falling exchange rates and growing trading partners is inflationary. 2015 has seen terms of trade fall as commodity prices take a turn for the worse. Terms of trade have fallen almost 100 points from 2014 levels, and we believe it has further to fall yet. Terms of trade are expected to have a deflationary effect on the New Zealand economy. Export prices are falling, and whilst dairy leads the way, it is followed by other main exports such as timber and meat. As shown here, from 2014 to 2015, exports have fallen further than imports, resulting in a lower trade balance. Looking at the trend in commodity prices over the last 2 years, we predict further decline in the future. This is going to be deflationary as net exports fall. Dairy is by far our largest export industry. However, world dairy prices have fallen drastically in 2015 due to oversupply in the market. At the 1st of April, the change in global dairy trade price index was negative 10%. Locally, Fonterra's farmgate prices have fallen by almost $3 in 1 year. This has immense flow-on effects for all sectors of our economy. As farmers lose income, their consumption will decrease, there will be less investment and less tax revenue. It is definitely one of the biggest economic issues we are currently facing. It results in a large deflationary pressure on the New Zealand economy. From looking at the factors of potential output and aggregate demand, we have come to the conclusion that there will be some inflation in the New Zealand economy. Since the inflation rate is currently low, we believe we should not change the OCR, as the inflation rate will rise to the 2% mark without Reserve Bank intervention. If the Reserve Bank implements monetary policy, we feel that it will overcorrect the inflation rate and require further intervention in the future. Conflict in the Middle East is a definite risk as it heavily influences the price of oil. The Trans-Pacific Partnership Agreement has potential to impact future decisions, and a ban on foreign property owners could potentially bring relief to the housing market. Serious domestic risks are falling dairy prices and low confidence, while global risks are currently centered in an unstable Eurozone and monetary policy abroad. Here we have what we believe are the biggest factors influencing our monetary policy decision. It is dominated by dairy, but house price inflation and migration levels also have a noticeable input. Thank you very much. We now welcome the questions.
Thank you. Very good. Some nice material. Of course, in June, the Reserve Bank actually did lower the official cash rate.
That is correct.
Can you explain what you think the implications on the New Zealand economy will be
So from lowering it,
from lowering it? Yep.
Well, there'll be all the things that are going to happen with the bank's interest rates and stuff. They're probably going to be lowering their interest rates.
Yep.
Trying to
So
get a bit
obviously
more
interest rates, exchange rate.
exchange rate, yeah. That's
Yeah.
going to be like raw
So the
materials.
first step is interest rates will decrease, right?
Yep.
So that's going to affect consumers as the becomes
Yep.
easier to lend.
As the cost of borrowing is going to be less.
Yep.
Yep. Definitely.
Then
So investments
producers.
are going to go up.
Yep.
Increase in investment.
Savings
Will go down.
down.
Yep.
So spending's probably going to go up then.
Yep. Consumer spending's up.
And
And
then
then
net exports.
Net
Well-
exports is going to go up.
Interest rates on exchange rate.
Mm-hmm.
So lower interest rate will mean
Decrease in demand for the New Zealand dollar.
yeah,
So what's it?
which means the exchange rate falls.
Yep.
Which
So
means
good
that-
for our
Increase in
exporters.
Yep.
Decrease in imports.
Does it have an effect on
So it's
supply?
an increase in
Imports go
Yeah.
down,
Yep.
which means that cost of raw materials is going up.
Yeah.
So supply side. So it's going
so-
to increase
so-
aggregate demand. I mean, we got consumption, investment, and net exports all going up,
Yeah.
and it's going to
Will it have an effect
Yeah.
on government at all?
increase of
won't change government so much, and it will decrease supply. So it's going to boost up that inflation rate,
Yeah.
hopefully towards
increase
the target.
price level.
And future productivity.
Yeah.
So
Future
future
productivity.
increase in aggregate
Increase in
supply.
our full capacity, maximum capacity.
Will it have an effect on expectations? Do you think?
Yeah, definitely. Because they'll be thinking that things are obviously looking a bit bad, which is why they've dropped it. So then could be thinking about.
But then if they're expecting that prices are now going to go up, because when they lower the OCR, the prices end up going up, which means inflationary expectations
could be
increase.
So do you think
So
they'll
they could
spend
spend a little bit more.
spend now,
spend
rather than
now,
later.
but-
Yeah,
sooner
Mm.
rather than later?
Yeah.
which is-
Short-term-
which is
short-term
gonna cause
spending?
the price level to go up even
Yeah.
more.
Yeah.
Okay.
That it?
Yeah, we're missing either.
From lowering the
It's
OCR.
firms' cost of production as well,
Firms
because
costs.
they're raw materials.
Mm.
Yeah, the
Yeah.
supply.
Yeah.
Yep.
Yep.
Mm-hmm. So it is.
So the effect of lowering the OCR in June is there's going to be an increase in aggregate demand because lowering the OCR lowers interest rates. Lower interest rates lead to more consumption as there's less interest payments for people with floating mortgages, that sort of thing. There's likely going to be more borrowing to purchase houses possibly in the current situation. And it's also going to decrease savings because the interest rates savings will get is lower as well. Investment also increases with lower interest rates just because of how it's cheaper to borrow now. And also net exports will increase because a lower interest rate depreciates our exchange rate, which therefore will boost our exports because they become relatively cheaper for overseas buyers, and it lowers our imports because imports become relatively more expensive. And because imports are becoming more expensive, it means raw materials become more expensive, which does lower aggregate supply a bit. And higher aggregate demand, lower aggregate supply, we're going to see an increase in the price level from that.
Good. Thank you.
Thanks, guys. So as you noted in your presentation, the rate of inflation is currently very low. I think at the moment it's around 0.3%. Is it bad that the rate of inflation is this low?
There are definitely negative effects of disinflation or deflation.
Yeah, so we don't want deflation. That's
No.
for sure. I mean, what does the Reserve Bank want?
Inflation.
They want inflation at about 2% over the
1
medium
to
term.
2% with a
Yeah.
target on to.
Yeah, target on 2%.
It's
So-
bad for firms
Yeah,
because they're not getting as much.
yeah. So they want to
Firms
keep
and
it
sectors.
stable. If a low inflation rate does mean it's going to be fairly
but the
stable,
question
but if
was-
it's too low,
Why is it bad?
then why is it bad?
Because firms receive less profits
We
from
want
new
economic
businesses.
growth. We want economic growth.
Yeah, I think will come down to economic growth mostly.
Yeah.
Because when we buy things, sell things, it makes inflation. As we produce
right,
more, we
yeah.
get more inflation.
Yeah.
So if we've got a low rate of inflation,
Then
it
we're not
means that we're
contributing to the
yeah,
economic
it means
growth
we're
as
not going to
much.
be growing as much.
Yeah.
Yeah,
I
that's
think
true.
that's what it's.
But also, Yeah, I
And
guess
that's what,
you can think about the flow-on effects though from firms.
Yeah.
If they receive less profits, they're going to have to cut costs. So
Mm.
it could affect
But
employment.
the
Do you
price
think, or
of
do you not?
the price of cost of their costs go up as well. So the price of the product goes up, but also the cost of it goes up as well. So it might not change profits so much
From deflation.
from inflation.
Low,
Sorry, but
low inflation.
But
same.
why? Oh, right, okay.
So why is low, inflation bad?
Yeah.
I think it just means we're not really growing. We're not really expanding
Yeah.
much more.
Yeah.
And well, that's what we want, isn't it? We want to be
Wanna be
a nice steady
like,
growth rate, and price stability. But price stability means planning for the future, right?
Yeah.
Which means if,
So for both consumers and firms, they're
Yeah.
going to struggle.
which is
to
why you want that
plan for the future.
Yeah, you want that midline.
Yep. Is that it?
Yeah.
Sure.
So, a low rate of inflation of about 0.3%. That we see that as bad because obviously the Reserve Bank's target is between 1 and 3%, focusing on that 2% midline. And the reason we aim for that is because it's nice and stable, which lets businesses and consumers plan for the future, that sort of thing. And it means that our economy is growing. When the economy grows, it does cause inflation. As we buy more, sell more, that does cause inflation. And if we've got a low inflation rate, that's usually an indicator that we're not growing as much. We're staying relatively same size, and that's not really what we want. We want to keep trucking forward, and we don't want deflation. And if we've got a really low inflation rate, that doesn't give us much of a buffer between inflation and deflation.
Cool, that's a good answer. So when inflation is forecast to be low in the medium term, the Reserve Bank is typically going to drop the official cash rate. What do you think would happen if inflation was very low and forecast to remain low, and yet the official cash rate was at or very close to 0%?
Well, there's not really much you can do, right?
Well,
Right.
you just got to look at
Yeah.
what other things they can do.
Yeah, different.
So, what was the question? The official
If
cash
it's
rate's
very
0.
low, really low inflation.
Oh, and very low
cash rate-
inflation. Yeah, that's right. Okay.
So if it's not quite 0 yet, then they still might lower it down to
Still not
close.
that
But
final option, but you wouldn't. If you
but,
want to
yeah.
look at something else, you could do.
so
You probably want to like jawbone them, like try
Yeah.
and get some.
try and manage
expectations
expectations.
Yeah.
Yeah, is that the only thing you can do?
Well,
Can't they change? Can they not change those then?
bank. Oh, they might be able to change OCR a little bit further down, but obviously you can't really change it to negative something.
Okay, so what would
Um,
happen if it was? What would happen to the economy though?
I'm thinking
generally?
maybe banks regulating what the banks can and can't do.
Yeah. How
Um,
much like cash flow?
What
there
about
is
money
to it?
supply? Would they be able to do anything with money supply? You know how you got that MV.
Yeah. In
PQ.
vehicles. Yeah.
Because what you're aiming to increase the price.
So
of it, right?
if velocities.
Yeah.
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 'Cause
Yeah.
you
They
wanna
could increase the money.
So if they increase the money supply,
Yeah.
so that pretty much comes down to what other things can the Reserve Bank do.
Yeah.
Was it the
So-
question though? Was it what
Yeah.
can the Reserve Bank do, or was it what would happen if that was?
What would they do?
Oh, okay. Yeah. So jawboning could be one though as well.
Yeah.
Anything else?
No.
So if inflation was very low, and the interest OCR is already near 0%, obviously you can't keep lowering it forever. So that's when the Reserve Bank would have to turn to other means of trying to boost production, trying to give a bit more inflation, that sort of thing. And so the main thing would be probably jawboning, just trying to control expectations and what people are thinking. That'd probably be one of the main ones. And also any changes to banking regulations, just trying to make it a little bit easier to borrow money, which means spending would be encouraged for investment and consumption to give that a bit of a boost. And then the other thing is the cash supply. If we increase the money supply, we usually find that there's an increase in the inflation rate. So that would probably be another option that the Reserve Bank would do.
Very good. Can I ask, if you wanted to increase the money supply, given interest rates are already 0, how would you do it?
That's a good point.
You would look to buy like stock back off the consumers, wouldn't you?
Yeah.
like say how
You could always just print more money.
No, you can't.
If they, what would they do? If they sold a lot of New Zealand dollars on their foreign exchange market,
What about
and then that money
assets?
is probably not going to be coming back into our economy, is it?
Could they buy assets?
Yeah, so you'd have to look at buying back assets.
Yeah, buy
buying
back
previous
assets.
assets.
Yeah.
Yeah,
Do you
buying-
reckon?
so buying back assets, anything else?
No.
So the main thing we think would be to buy back assets, really.
Yeah, that's right. You could also intervene in the currency, which is buying a kind of asset, which is foreign currency, giving New Zealand dollars. And the other kind of assets you would be thinking about would be government bonds or other corporate bonds. Okay, that's a very good answer. Changing topics just a little bit. We have seen oil prices fall quite a long way. We've also seen dairy prices fall a long way. Can you explain the implications of those changes on the New Zealand economy?
So both the change in oil and dairy.
Yeah, and concentrate on the fact that the different types of commodities, so they'll have different impacts on the New Zealand economy.
So
Yeah.
oil's going to be firms.
Yeah, we talked about this the other day.
Yeah,
Oil's
'cause-
actually going to be positive, isn't it? Cause
It's going to be partially positive because we
do
export oil,
Yeah,
a lot
but
of
we
oil.
import a lot more than
Yeah.
we
we
import more
export.
than we export. Yeah.
So it's mostly going to be we'll just separate it as
Yeah, we'll
oil
just
is more of an
okay.
import.
Oil's probably more of an import than export.
Yeah,
So-
and and firms use petrol,
Yeah.
which is
Yeah,
which
Use
is
them
so
in
what
their
yeah, cost of production.
everyone uses petrol.
So that's positive.
Mm.
So that's
it's a
gonna
lower
you're probably
cost
gonna
of production,
which
Yep.
is good.
which is gonna
Increase
increase
Yeah,
production.
increase. That
Yeah.
could potentially this is really long term. That could potentially increase like investment and almost employment because
Yeah.
firms might expand
Yeah,
because they've
just
got
'cause
more
they-
money now,
Not having to spend as much on this, so they can
more revenue.
look at employing more people.
Consumers use a lot of oil as well. I
Yeah,
mean, if
that's true.
that's pretty big cost for consumers, which
Yeah.
means that they're going to have more money in their back pocket
Yeah,
to
so there'll be more
spend
disposable.
otherwise.
So in terms of supply though, because this is the cost of
production,
imported
so then
raw
we could
material.
could see an increase in the quantity being supplied.
Yep.
But oil's cost of it's an imported raw
Raw
material,
material, so
so that would
aggregate supply.
aggregate supply would increase. What else in terms of oil?
Yep.
Um,
So as a use production we've got, it's going to investment.
Yeah, and we
It's
could-
going to lower the cost of firms so they can produce more at the same
Um,
price.
Yeah, but we've also got to think about like the New Zealand companies that produce oil and then export it. They're going to be feeling worse off. So then there could be
Yeah.
like in certain areas up at margin point. They could like that area could.
Yeah, so we will have a
Feeling
little bit of a
worse off.
negative from our exports of oil, but
Yeah,
but
it's
it'll
going to
probably
be
be out-
mostly positive
it'll
from
be
our
outweighed.
imports.
Yeah,
you'd think
imports would
outweighed, so it
outweigh,
would
yeah.
actually.
Mm-hmm.
Okay, so
We just got to look at the demand side of it though. Is
yeah,
that-
so consumer spending's probably going to go
yeah.
up. You would think, wouldn't you?
They've got more to spend on other
More to
things
spend.
anyway.
Investments, long-term investment will
Expectations.
Oh, yeah,
Yeah,
expectations.
yeah, so they could be
go up. So you
because
could
they're
see
going
an
to be
influx.
they're going to be thinking that they're not going to spend as much on.
Sort of like this
Other- yeah.
multiplier
Fuel
effect.
Yeah, yeah.
Multiplier.
So then that could
More
follow on
space.
to.
Yeah.
And
So,
so
aggregate demand's going to go up though.
yeah.
Overall. Oh,
E- aggregate supply will increase. Sorry.
increase.
Well, we've got
beg
an
your
increase in investment, increase in consumption, decrease in exports,
Yeah.
decrease in
Either consumption will increase or savings will increase if they save that money instead.
Yeah. You can't really say consumption will increase.
Aggregate demand's definitely not going to fall. From it.
Yeah.
Okay,
But it
should we
means our
move on to
imports are
dairy?
increasing. So, aggregate demand won't have that big a change from oil because
Not
imports
really.
increasing.
So
Um,
it's going to counterbalance the
Mm.
effect of the other ones increasing.
Now, dairy price.
Yeah, so let's move on to dairy.
Yep.
Okay.
That's negative for us
Yep,
because we're
so
we
It's our
rely.
biggest
So
export.
decrease
Yeah.
in investments
We
from
rely on
because
Yep.
that's like our main
Yep,
investment
definitely.
on farms.
Yep.
You'd probably.
And like new
Oh,
developments and stuff.
sorry, just to go back to the other one. Transfer payments.
from oil.
Oh no, sorry, from dairy. I
From
mean,
dairy,
yeah, because if firms are going to lay off,
Workers could be more
Workers.
unemployment.
If they lay off workers.
then an increase in treats, so that would increase government spending, but probably not by a lot, would it?
It's sort of a flow of the chain, though, I guess.
Yeah.
I mean, it starts off exports decrease because even if we sell the same volume, we're getting less. If we sell more volume, there's still a good chance we're going to get less into the economy
Yeah.
because it's not like demand's increasing heaps with price decreasing.
Yeah. Yeah.
You know, so net exports will decrease.
Well,
Yeah,
they're
definitely.
still going to have to sell all the milk they produce.
So that's why the price is lower.
Yeah. Yeah.
Okay. Consumption.
And then consumption's going
Yeah,
to
then it
down
flows
flow
on.
effect.
Farmers
flow
spend
on.
less.
Yeah.
And farmers normally spend
Farmers
less.
invest less.
Yeah.
In terms of supply,
Will it affect supply? I don't.
probably won't.
Won't it? Will it affect supply?
Maybe for like other things.
Maybe
like
investments
milk
for
powders
future
and stuff.
productivity.
Oh no, this is on the world dairy market.
Yeah,
The
it'll be
prices
the world,
falling,
yeah.
yeah. Okay.
Okay.
And transfer payments, like Sydney said,
Yeah. Got that.
could potentially.
But
increase.
even for the oil, because if in long term, if they're employing more people, they could decrease
Yeah.
transfer payments for
Yeah.
oil. That would be really long term though.
Did you want the effect of both at the same time or separately?
You can separate it if you wish.
Yeah.
Off you.
Anything else?
No,
No.
I think we're good.
Alrighty. So the price of oil decreasing will have a good positive impact on aggregate supply for New Zealand because it is a big cost of production for firms, and that means that pretty much we're going to be able to produce more at the same price. It's going to have a mixed effect on aggregate demand. On consumption, it means we're going to be able to have more left over to spend elsewhere, but that does mean we've got more left over to save potentially. So it is going to have a mixed effect there, but investment should increase because costs a lot for firms. They're going to be feeling quite good about themselves, so they're going to invest in some new equipment, and it just means that, so the aggregate demand probably won't shift so much because that'll be balanced out. The change in investment will be balanced out by change in imports. Imports increasing will lower aggregate demand. So aggregate demand will probably stay fairly steady, but aggregate supply should increase, which is good for us. Lower price, more quantity. With dairy prices falling, obviously that lowers our exports because we're just not getting as much revenue for the same dairy products that we're selling. And then that there has big flow-on effects because all those farmers now have less income, so they spend less, so consumption decreases, and that therefore leads to other people's incomes decreasing, that sort of thing, multiply effect, that sort of thing. Investment will decrease because things aren't looking so good for the farmers. They're not going to be able to have the spare cash to go and invest anymore. There is potential for transfer payments from the government to increase because of if there's farmers who no longer have work because of production decreasing. And yes, that'll decrease aggregate demand. Won't change aggregate supply, but it'll decrease aggregate demand, which lowers our output and raises prices. Lowers prices. But yeah.
Using those scales,
Yeah.
the two together, what's the net effect?
What's the net effect? Aggregate supply goes up, first of all, from oil.
Okay.
Yeah, definitely. In long term. Yeah, aggregate supply.
Aggregate supply goes
Definitely,
up
yeah.
because, and that's just from the oil.
Yep.
Dairy won't impact that.
But mixed with dairy and oil together for
Invest-
demand, investment's probably going to balance. Would you think?
Yeah. Yeah.
Which one has more of an impact?
I'll probably say
Dairy.
the dairy.
Dairy.
Here.
Yeah, I'm thinking dairy has
So
a bigger
almost
impact.
investment, you could say, could go
Yep.
down
Yeah.
slightly.
Yeah,
Because
or
they
at
kinda
best
outweigh,
it'll
but
just sort of balance each
balance
other
out.
out.
Decrease in
Consumption will probably go down. I'm thinking
Yeah,
probably
Yeah,
going to go down.
probably. Yeah, because dairy's so big.
So So we will combine. We'll
Yeah, so combine them.
AD
So-
won't change too much, so.
I think
slight
AD
decrease.
Yeah, decrease.
Slight decrease in AD.
Summarise that where you got to.
Yeah.
So together, because of how our economy is set up, we're largely based around dairy. Although oil will have a big effect on our inflation rates, dairy is going to have a bigger effect. So aggregate supply will still increase due to lower oil costs, but it's going to be largely outweighed by dairy and the flow-on effects from a loss in dairy income revenue. So overall, it's going to probably decrease aggregate supply, increase aggregate supply, decrease aggregate demand. And that would just cause a bit of deflation or a lot of disinflation.
Okay, very good. Because we're out of time, can you keep your answer to one word? But what would be the impact on the exchange rate?
Down. Down.
Say decrease, it sounds a bit smarter.
Depreciate.
Oh.
Yeah.
Depreciate.
We're done. Thank you very much. You can relax now.